step towards the right direction, even though it may be lacking details in specific areas, and even though the implementation of this set of principles towards denuclearization may take time, it's still a very positive step. And exactly as you say, in terms of the ETF flows that we have been seeing in Europe, so far it has been very risk averse. Gold record monthly inflow in over a long time. For the first time in over 1.5 years, we see outflows from emerging market equities, continued outflow from European equities, U.S. equities being a bit of an exception because earnings are so strong and growth is so strong. But more broadly, the flow picture definitely paints a very risk-averse direction investors are taking. So this change in terms of kind of geopolitical development should be supportive, at least in the near term.
If you separate out emerging markets and then look at all the key risks, I think there seem to be many different elements in different countries, from Turkey, which seems to be improving on the risk scale, to Brazil that is moving even lower, to question marks around the growth story in China. What do you need to weigh up right now as you sort of step away from this historic summit and think about some of the fundamentals?
I think when it comes to emerging markets, earnings are very important. And so far, the earnings momentum that we have seen from emerging markets are reasonably robust, not just coming from one country, not just coming from commodity, one sector, is rather broad-based. But however, having said that, when you look at, you talked about Turkey, Argentina, what's going on in India, the rate hike, surprise rate hike last week, for example, it all points to a tighter liquidity environment. And that is not just coming from developed market, the Fed normalizing policy, but also in emerging markets as well. So even though as a firm we're still constructive on emerging market equities, we're very much aware of the fact that 2018 is not going to be a repeat of 2017, where the asset class delivered very strong performance. The environment is a bit more mixed. Emerging markets equities will have to kind of be torn between robust growth dynamics and robust earning alongside tighter liquidity condition, both from developed market as well as in the emerging market themselves.
I mean, what's been interesting, I think, is the emerging market flight has not only been in equities, it's been particularly around bonds. And if you look at EMB or other ETFs that represent the attractions of emerging debt, you know, we're now around 5-year lows for many of the prices on these products, which tells you that actually there's a much bigger fundamental shift going on, isn't there, around expectations as to what these markets in particular are going to do next?
I think when it comes to investing in emerging market bonds, a lot of investors look at what they can get in terms of equivalent from developed market. So if you look at US 2-year around 2.5%, US 10-year around 3%, hovering around those levels, the yield pickup that you get from emerging market debt over the equivalent in US government bond is no longer as attractive as before, which is why we are starting to see outflows from emerging market debt, especially in the local debt space. More recently, we saw spread backing up in dollar EMD, which in our view actually presents interesting entry points.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.